My name is Victoria Greene. I'm the CIO and founding partner of G Squared Private Wealth and a CNBC contributor. Today I'm going to talk to you about investing your portfolio like a professional or like a CIO. One of the biggest things we're going to discuss today is broad views on how to design a portfolio and implement it. There are three main ways to put together a portfolio and analyze investments. Number one would be fundamental. Number two would be technical, and then number three would be top-down or macro viewpoint. We're going to dig into all three of those in a little bit, but what we need to understand is each can be good in their own way. It can be good as a short-term indicator, long-term trends, so you need to understand and embrace a philosophy, and the number one thing is don't jump around. If you're using technical analysis, then stick with technical analysis, because one thing that can get people in trouble is starting to look at an investment one way, not working out, flipping to another way, not working out, and they're constantly changing and overhauling their investment philosophy. So the number one thing is have conviction in what you do. If you put together a portfolio, you're analyzing investments, ensure that you're consistent about how you're doing that through good times and bad. Because the worst thing that you can do, especially if you're trying to think of this as a professional level, is to panic and or capitulate just because things are going wrong. If you have conviction in your philosophy, it's going to pay off for you in the long term. So let's start out with what is fundamental. Fundamental analysis means you're going to put together a portfolio by looking at things on a bottom-up level. So what does that mean? That means we're going to look at individual attributes of either investments, of sectors, or individual stocks and securities. This means we're looking at things like PE ratios, earnings growth, revenue growth, free cash flow margin, operating margin. This is where you're really looking in here. You're putting on your glasses and your microscope, and you're looking in and digging in and saying, what do I really like about this sector or this stock? This can help you out in multiple ways. Number one, you get to know the company very well. You should be very familiar with it. You should understand how it makes its earnings. You should feel comfortable with the management. You should like what it's doing as a company. And the ways we look at it, especially fundamental, is number one, we want a good moat. Is what this company doing unique? Are they able to protect their revenues? Are they able to grow their revenues and also protect them from threats? Because just because you're good at something, that typically then attracts other people into your industry. So are you good at what you do? Do you have a moat to protect your revenues? And are you actually doing what you said you're going to do? So some companies, you look at it and you say, that's a growth company. That means they actually need to exponentially grow their earnings. They need to actually execute on that. And so sometimes we see companies where they say we're this growth company, and then they're not growing faster than the market. So if you expect a growth company to do well, you need it to be growing faster than the market. If you want a value company, you need a company that is being disciplined with their spending, not trading at a huge multiple, and showing ways that they can grow the company reasonably, and they're not spending crazy, their balance sheet isn't expanding. So you want to make sure that what the company says they're doing, the attributes about that company, are actually how the company is executing. Fundamental can be absolutely fantastic way. You really get to know these stocks and sectors. However, it can have some drawbacks. Number one is then pushing into the top-down macro viewpoint. A lot of times a company has no control of what's happening in the world. Like, are we going to war with Iran? Or what's happening with inflation? Where are we on an economic cycle? And that can put you at risk that you may be in a sector or a stock that's just out of favor. They may be fantastic at what they do, but it doesn't matter because the world is a terrible place for this company right now. Think about things like automotive companies. When there's a recession, people aren't buying new cars. You might make an amazing car, but if everybody's stretched, nobody's paying for new cars. Interest rates go up, home builders are down. Things like that, where the company has no control over that, but it still really much affects them. So that's the next thing we're going to look at. And this is called top-down or macro viewpoint. And this is where you look at the world afar. You say, what countries do I want to be in? Where is everything? It's not just as an absolute basis, but also a relative basis. How is the US versus China? Do I want US domestic? Do I want developed international? Or do I want emerging markets? What mix of that do I want on the stock side? And then you also want to think about, how much risk do I want to be taking? Where are we in an economic cycle? Are we expanding? Are we contracting? Is risk growing? Are we coming out of a bear market? That means, where do I want to be on my asset allocation? That means, what's your mix of stocks, bonds, alternatives, and cash? And that's a huge, huge driver of return, because when you look around the world, you want to ensure you feel good about taking risk. How much more in stocks do you want to have? Maybe you have a benchmark 60-40 portfolio allocation. In a good market, a bull market where you feel comfortable about growth, we're in an economic expansionary cycle, maybe interest rates are low, the Fed's being accommodative, earnings are growing, everybody's excited, you might want to take on a little bit more risk and a higher percentage of stocks. But you have to be careful about understanding the macro regime you're investing in, because one of the problems is when you invest in a stock, when it goes down, it actually has to go up significantly more just to recover. Let's say I have a stock trading at $100 a share and it goes down 50%. That means now it's trading at $50 a share. A 50% loss. That's terrible, right? But for it to go back from $50 a share to $100 a share, back to where you were when you started, that stock actually has to go up 100%. That is a huge leap to go back from 50 to 100. It's much easier for stocks to fall quickly, a lot harder for them to recover that ground. We call that being on the risk management side and the loss management side. If you can be aware of that and you can protect a little bit on the down because the macro regime is changing and maybe it's not the right time to take a lot of risk, that can be a really great way to run your portfolio. You don't want to panic. I'm not telling you to panic sell if things are down 30%, but I am saying the macro environment can really drive some of these losses. Think about the major events and the major bear markets we've had and what drove those. It wasn't necessarily fundamental. A lot of them had to do with what was happening on the macro side. A lot of it had to do with the Fed, with interest rates, with inflation, with unemployment, what was happening with economic growth. Some of them, like what happened in 2025, we had trade issues. It might be war-driven, oil spike-driven, some sort of trade crisis. All of those things on the macro level have significant impacts on what happens to your stocks and what happens to your overall portfolio depending on your risk. So one way of really successfully investing is to look at things and have a decision from the top down, this broad macro viewpoint. What's happening economically? How much do I want in every single bucket? What do I want in my stocks, bonds, cash, or alternatives? And then you can dig into that and say, of my stocks, do I want a little more growthy? Do I want a little bit more blue chip and protective and value and dividendy? Do I want large or small? Do I want US or international? Do I want emerging markets in there? Are there countries I like better than other countries? And you continue to break down until you get to the point that you set your overall investments. And you can do the same on the fixed income or the alternative side. So it's a really successful way, especially if you're very good at reading the macro tea leaves. The third thing we're going to talk about then is putting your portfolio together with a technical viewpoint. Now, warning here, technical analysis does typically work better in short-term trends. And it can be very risky because there's a lot of different charts out there. I like to joke sometimes that technical analysis is never wrong. The trend just got invalidated. That means that the trend broke, right? So technical analysis is reading charts and patterns and what's happening on volume, what's happening on trading, what's happening on fund flows, and most importantly, how is the price movement of a certain investment moving. Technical analysis can get very, very detailed. There's probably about 300 different technical studies you can do. The major ones that most people focus on are simple ones like moving averages. So when the 50-day crosses above the 200-day moving average, that's what's called a golden cross. That is a good sign that the stock is rising and the momentum's rising in a stock. And the golden cross is a good thing. The other side of that is when the 50-day average crosses below the 200-day average from the top down, and that's what's called a death cross. And obviously nobody wants a death cross. That's a horrible thing to see, and that could mean that there are more losses to come and the losses are accelerating. So that's a very basic charting. Other things people look at are things like RSI, or they're looking at patterns like a head and shoulders pattern, or they're looking at breakouts, or they're looking to see if this is all of a sudden forming a new pattern. Maybe a stock has struggled to trade above a certain level and suddenly it finally gets above it. That can be a huge bullish indicator. You know, and you have millions of different ways of looking at it. You can break it down into tick by tick or minute by minute trades. Charts can get very, very complicated. So I feel like if you want to use technical analysis, number one, it can work very well, especially in the short term. A lot of trading patterns tend to work well there. But we also want to be aware that things can move it. Let's say an announcement happens, a tweet happens, right? We sometimes see the market very easily moved by social media these days. A tweet comes out, it doesn't matter sometimes what that pattern was trading like, it can invalidate it. So just be careful, don't overextend yourself, understand it's extremely complex, and also pick the technical studies that you're interested in, and that one really does take some learning behind it because it can get very, very in-depth and technical beyond the simpleness like the RSI, MACD, advanced decline, moving averages. Those are kind of your basic tools. If you get into technical analysis, I certainly would ask you to go and look a little deeper and make sure you're well educated on what you're looking at, because the patterns in charting can be very, very complicated. A lot of people love to produce charts that have about 15 different lines and intersections and where it's going to go. And sometimes I say, okay, some of these charts absolutely make sense. Some of it I feel like people just draw trend lines when there's not really a trend at all, and then they're picking which trend line to follow. So it can be a little bit difficult. Obviously, as you can tell, I'm more a believer in the fundamental and the macro viewpoint than the technical, but I'm not agnostic to technicals. I think it's a very good way of kind of reading the tea leaves a little bit on sentiment, as well as where is the short-term pattern going. So as you're looking at your portfolio and you're looking at the world in general, I think one of the most important things of looking at your portfolio as a professional or like a CIO is have a philosophy. Stick to that philosophy. Educate yourself on how that philosophy works. Look at what it does in up markets and down markets. And the most important thing is have conviction and don't be jumping around. Jumping around is the fastest way, especially if you're changing your philosophy all the time. It's a very fast way to destroy money. You could potentially have issues with gains if you're constantly moving around, as well as just the fact that staying invested in time in the market is often much more successful than timing the market. So good luck, happy hunting, and I hope you put together a great portfolio.